Well, good evening and welcome to this live stream event on the 23rd of November 2021. Martin North from Digital Finance Analytics here. Great to have you on board, and this is going to be an interesting conversation, not least because I actually spent a few years of my career years ago teaching capital markets, derivatives, option futures and all the rest of it. And now I've got a guest on tonight who also has a very good exposure and experience in the subject. So hopefully we're going to have an interesting conversation. Just before I bring Michael in, let me just run my normal warnings, which is to say this isn't legal or financial advice. It's a general conversation. Do please play nice in the chat room. We do moderate the stream. This is as of the 23rd of November 21 if you're watching in replay. And if you have a question for me, use @WalkTheWorld to make sure it gets to my attention. And I've also enabled Super Chat, which makes sure that if you want to get your question top of the list, you can do that. Or if you'd like to make a contribution to help run the shows, that would be greatly appreciated too. We don't do this out of a desire to make profit. We do it because we think this is a really important conversation. But of course, it does cost to do that. So any contribution gratefully received. Well, with that, I'm going to hopefully bring Michael in now. Let's just push this button. Michael, are you there?
I am. How are you?
I'm very good, and welcome to DFA. Thanks very much for coming on and spending some of your Tuesday evening with us. And you are a bit of an avid follower of DFA, aren't you?
I am. I follow the personalities like Edwin last night. And, I like these WeChat chatters. I love that sort of talk and getting information out of that. And you had one of my favourites, Steve Keen, on the other night, which I thought was very nice. And the good work he's doing, especially getting into politics. So,
well, I would say he's a braver man than I when it comes to politics. But no, that's great. And thank you very much for sharing your expertise with us. I guess there's a whole bunch of ways we could tackle this, but what think my objective is to try and help people understand the relationship between, the main money markets and the financial system and the derivative system, right? Because depending on who you talk to, and I picked up this slide just to show, people saying there's a $1 quadrillion in the derivatives worldwide. It's huge, right?
Yeah.
Now, it depends on how you measure it, of course, as we'll come on. There are other numbers that people throw. This is the BIS one, which basically says, well, it's 18, 20, 30 trillion, whatever. Yeah. Still big. Right, and back in 2010, the Reserve Bank made the point that the Australian banks' derivatives positions were about 12 trillion Aussie dollars, right? And that was in 2010. Interestingly enough, they've stopped reporting gross positions. I wonder why. So.
We know why.
Yeah, we do know why, and we might get into that shortly. But let's just start with a bit of introduction of yourself
Sure.
and Emerald Financials. And I know you've got some slides. I'm not sure whether you want to switch to those slides directly or whether you'd like to talk a bit beforehand. But I'll leave that with you to figure out.
Well, can I grab a screen?
Yeah, do.
Sure. Let's see if I can pick something up there. Just as a way of introduction, I'll just pop up this. Sorry, jumping around a bit. I better do my general advice warning, just to advise that everything's general.
You haven't shared the screen yet?
Haven't I shared the screen yet?
No,
I'll try that again and share.
Yay.
Yeah, it's come up?
Yep.
Yep, good. Just the general advice warning, saying that it's all general advice. We don't take into account your objectives, financial situations or needs, and we don't consider whether it's appropriate for you. Information is only for educational purposes. Who do I represent? We actually have three companies in our group. One is Trader Circle, which trades in the options, the equity options derivatives market in Australia. Predominantly, our business is educating people, training them in the market. So we run a full service desk. And the group employs about 14 people in various disciplines. So Business Trader Circle is about options and training education. and trading.
And Michael, just a question there. When you say the people you're training, are they sort of individuals or are they firms, or what's the type of clientele that you're talking about?
Yeah, so we're purely retail focused.
Yep.
And sure, we'd have a few sophisticated investors in there, but we found the niche in the market to educate people on how to trade the traps. I mean, for anybody who's done some option trading, the vagaries and the intricacies and the difficulty you can get even in settlement, let alone early exercise or any of these things, it's truly a minefield. And knowing the etiquette of the market. So, and what a lot of people do, they go into the markets, they trade it themselves, and they find their weak spots in trading a market. And at the end of the day, what you need is knowledge, discipline, a trading plan, capital management, all these things. And it doesn't matter whether you're trading options, derivatives, equities, bullion, commodities. The education points are all the same.
And Michael, I suppose that what that means is that whenever anyone is trading anything, right, there's a set of things you need to think about. But when you're actually trading derivatives, one of the critical differences is the leverage, right? Because basically
Correct.
The whole point of derivatives is you can effectively multiply your exposure. And that could be good, it can also be bad.
Yeah, correct. But the leverage is not outrageous as how the CFD providers got down. It's not 100 to 1. It's not 200 to 1. It's probably in the 6 to 10 leverage. And the thing too with options, you can the strategies we teach people is limited risk. So you can buy an option and sure, the most you can lose is what you paid for it, but you can't lose any more. You're not going to, after having bought an option, you're not going to get another margin call. So the things we want to teach is how to avoid unlimited losses, which are pretty much frowned upon in our market anyway. And
it's worth saying there are people who have lost a lot. And in fact, I'll just tell you the reason why I ended up teaching futures and options and things years ago was because I worked for a large financial services organisation, and they actually got themselves into terrible, terrible trouble because their senior executives didn't understand what they were getting into, created huge exposures and took great losses. And so there was an edict from the board saying everybody in this organisation at the senior level, so the top 300 people in the company, needs to understand how this stuff works, because the risks of getting it wrong are so severe, right? Yeah. Now, that's in corporate land, but it's also true, I think, in retail land too, that if people don't know what they're doing, they can actually end up tripping over themselves and getting themselves in quite deep water without really necessarily fully understanding. So, understanding this stuff is really important, and that's one of the reasons why we're having this conversation.
That's exactly right. The idea is to go out, whatever situation is, to go out and educate yourself. I mean, if you're going to go into any market, whether it's equities or, as I say, options or CFDs, even educate yourself. And all different type of products have their own sort of nuances about how you could possibly lose money. So Trader Circle is our options business. Emerald Financial is the equity side of the business, where we bring in a lot of research. We do stock screeners. We could do recommendations. So what we do in options, we do in equities, we have a stock scoring system in the Australian and US markets, and an ability to trade Australian and US markets. But again, it's retail focused. It's talking to people. It's people, retail clients. They could call us 4 or 5 times a day and have a conversation. And the little questions is what bothers people. It's not the big questions. It's how did that happen, or why did that happen? And our job and our whole business is explaining things to people and letting them gain some knowledge. We have a third business that I don't think I previously mentioned to you, but we also have an investment relations business. And again, it's retail focused. So we have about 7 companies we act for on an investor relations basis, and companies you may have heard of, which are Healthier, Novarti, Class Super, Crowd Media, Harris Technology. And our job there, again, is not getting away from the retail clients. It's actually retail communication for listed companies back into their shareholder base. So we're very, very experienced at communicating. So if a company wanted to do a share purchase plan, we're more than capable of contacting 3,000 people and saying, you're a shareholder, what do you think, that sort of thing. So so our business is retail focused, retail education, and solving people's problem, and sort of the information we're covering tonight. We're going to pick on things that are, one, interesting and good knowledge, and 2, I think it can help you with your perception of what the risks are in the market, and that you possibly normally find with somebody else.
Yeah, great. And let's then move the conversation forward. So there is, of course, a context for derivatives, right? And a context for all of this, which is the overall structure of the financial markets. And over the years, derivatives have become a very significant part, not least because many organisations not only take derivatives to protect against risk, but they also take it to take positions, right, to speculate on movements in a particular way when prices go up, prices go down, right? So to what extent is the difference between speculating based on taking positions versus risk protection? I mean, those two things seem to me a little bit different.
No, I hear what you're saying. I think what we're finding in the derivatives market, and that's the futures market. When we derivatives are the broad class of futures and options. The derivative market, as applies to futures, is today we've got a share price or a commodity price, and a futures market is just a price in March for that same product. What's the price in June for that product? What's the price in September? And so it's called futures. It's a future settlement date. And what's interesting is that when you look at gold futures, you might find that the main months are March, June, September, December. They might find that the June future is trading beneath the March future, and what message is that sending to market about that there is some information in what the future prices are. So futures are trading the same price on future dates, and options is that on every futures date, so let's take March 2022, yes, there's one price for that gold commodity, but there's a whole string of options you can write on the March maturity. They can be obviously call options, put options. If the gold price is $1,800, you could buy an $1,800 call, you could buy a $1,900 call, you could buy a $1,600 put. And that's the structure of all the derivatives markets. Is there's futures dates, and then you can write options there. So because the derivative markets, and especially I think I love the gold contract. What the banks have done with gold, and especially in the London market, is that you can turn gold into money, and it's an interesting statement. But so you could go to a London bank and say, "Listen, can I give you $1 million, and can I put that into a gold deposit?" And the London bank will issue you a gold certificate. But it's not a gold certificate backed by gold in the vault. It can be, but predominantly it's not. So they give you a certificate and say, "Listen, we'll deliver you $1 million of gold in the future, or whenever you want." And what the bank goes and does is it will go into the futures market and buy that futures contract to hedge itself off. And you think, oh well, you sell it to a client for X dollars, I hedge it at another, and there's a bit of profit in that. What it actually does is it actually creates money. And so when the client puts his $1 million deposit on, well, that's a deposit for the bank. It's real cash. And they can use that cash to on lend. So, and so from the client point of view, they're long gold. From the bank's point of view, they short gold. The client hedge it off in the futures market, but they've got this $1 million, and they can do what they like with it. Go buy a government treasury, buy some corporate paper, go buy some evergreen bonds out of China. So the futures markets are very much a platform for the credit creation that goes on in the global markets. And I think it especially applies to gold. And I think we'll touch on Bitcoin, how what's happened with the gold market, and that's been such an old market, is that it's multiplied the supply of gold in the market beyond the underlying fundamentals.
Right. And Michael, just let me come in on there, because I think this is a really important point that you're making, right? So the original idea of futures was, it came out of farming land, right? So your farmer wanted to know the price of corn so that he could actually work to it. So the futures contract would be, I will deliver my corn in 9 months' time once the harvest is gone, right? That's
Correct.
when it started, right? And then, of course, people realised that you could actually do future delivery of other things. So the futures market is essentially a future promise to deliver at a certain point in time a certain amount of corn or gold or even a currency, right? But then the options part of it is a right but not an obligation to do that. Right? And the option stuff can be spread around the price. It can be higher or lower than that implied future price of the futures contract itself. Right?
That's right.
And then it means that you don't necessarily have to have the commodity at the point of delivery, because what you can then do is you can offset, you can basically protect yourself by using some of the other instruments. And in fact, you can do it not just once, but you can do it multiple times, right? So the really interesting question is, what's the multiple between, let's take gold, what is the multiple between the underlying amount of gold that's there, right? And so that's in, if you like, in the spot markets, and the true exposure in all these various derivatives. And it's somewhere between, 50 or 100 times?
It's the talk is 100 times. There's no question. There's 100 times gold. I think there's about $12 trillion worth of gold in the world market, if you add it all up. There's been a common complaint, and especially with the London gold market, that there's a synthetic 100 times gold out there. And really, once you move away, so you'll hear a lot of commentators, and especially YouTube commentators, say, don't buy ETF gold, don't buy, you need to buy physical gold, because the only way you can guarantee the gold's there is actually if you got it in your pocket, and a la that silver, the Reddit silver, saying buy physical. There are a lot of reputable exchange traded funds in gold and silver that absolutely guarantee to own what they call allocated gold. The gold is in the safe. You need to know your gold is there. If you take a few of the other big exchange traded funds, they'll say in the prospectus it's unallocated gold. And what unallocated means is that the gold doesn't exist, and there's a promise to pay. So you have a counterparty risk to the person issuing that exchange traded fund. And so that's just another form of banking. It's just another form of risk. And it goes back to the start of money, or can we say the start of gold back in 1700s. They found that if they had 1,000 ounces of gold, they could lend out 10,000 because the chances of somebody coming in and asking is only one chance in 10.
But just to come back to that, you made a really important point about the multiplier effect, right? So, from that first transaction, you get multiple transactions, but that means that there is actually creation of money in the process.
Correct.
Right? And that's a really important thing to understand. So it's not just central banks, right, creating all of this stuff that's sloshing around the systems. The derivative processes is another force of creation of liquidity.
The world is entirely interested in creating money, and I think we go back to Steve Keen's research. It's the modern the economists for the last 100 years have ignored money in the system and credit creation, and that's what Steve goes on about quite rightly. And he's saying, bring it into the system. We need to understand it. But clearly, even the Federal Reserve in the US ignores shadow markets. They ignore all this money being created in the background. And there's clear evidence there are a lot of shadow markets out there which are being ignored.
And Michael, let me go back to this chart that I showed a little while ago, right? The reason that it could be quadrillion, if you count up all the individual contracts, right, that are out there, all of the cross-leverage and all of the different commodities and all of the different, exchanges around the world, it could well be that. But that is just the total, if you like, face value of all those contracts. The truth is, of course, they're all netted off against each other.
But there's your problem, but go on.
Yeah, but so the question is, nobody quite knows what the real exposure is. And of course, also, if things change, so if price moves dramatically, those exposures can suddenly bite people on the bum, can't they?
No, exactly right. I'll make a point. So the quadrillion is only 1,000 trillion, by the way. So it's not that big. And the point, let's get into the risk management point of what you've just said. Like if I, my trading goes back to the capital markets in the 80s. So if I buy $1 million worth of anything from Westpac, and then 2 days later I close off that position by closing off against ANZ, in theory, I have no risk. I've bought up Westpac, I've sold it to ANZ, I've got no risk in this derivative market. But in actual fact, you've got counterparty risk. And you've still got $2 million counterparty risk. even though you've, and this is what happened in the GFC, and this is what blew everybody up, which is, Bear Stearns, AIG, Lehman Brothers. What happened is everybody realised that I've bought $1 trillion, I've sold $1 trillion, I've netted off my exposure. But what they found is the person, that one side of the trillion fell over, so they were then left exposed on the other side because they had to make good the counterparty risk. And this was the scary thing. And there was a push to move from over-the-counter man to man. Bear with me. Excuse me. No. Sorry, I just got somebody walking in the office. I apologise. So this counterparty risk needs to be sorted out by central exchanges. So sorry, I lost the point there.
No, that's fine. Let me just come in there because, so some time ago, right, a lot of these derivatives were actually not necessarily what's called centrally cleared, right? They were actually basically bilateral arrangements, and nobody quite knew where the spaghetti was going to, right? And there's been an attempt in recent years to centralise into exchanges a lot of these transactions, so at least they're a little more visible. They've not been that successful, though, have they, in terms of getting everything? And there's an interesting speculation. The BIS were trying to work this out some months ago. Right? How much of it is still out there that we don't know about?
Untold, and we thought I might cover the point later on. But the offshore banking market, the unregulated offshore banking market, is huge. So what happened is in the 50s and 60s. The London banks and at the same time the US banks moved to the tax havens. And if you established a bank branch of Bank of America in the Bahamas, or a London bank, NatWest in the Bahamas, you didn't have any regulations. England and Britain didn't regulate you, and the United States didn't regulate you. So there is and as we know over history, there's complete secrecy in the tax haven countries, and so whereas in regulated markets you need 5% capital, 10% capital, in the unregulated markets they've got no capital, and there's a lot of discussion and study on the fact of what caused the global financial crisis. And a lot of people believe it was these offshore shadow markets falling over, and in fact we could talk about that for hours, and we might touch on it later today.
And let's just touch briefly. What we mean by shadow is basically not in the standard formal accounting processes in large organisations with the capital controls. Now that's to some extent fixed, but even those main organisations, large financial organisations, still have all sorts of ways that they can cover up some of these potential exposures. Now, in theory, they should be marking to market every day, right?
Yeah.
But that doesn't necessarily give them the true risk exposure. And so in the accounts of even our major banks and other financial institutions around the world, there are these great holes of risk that are not necessarily being adequately reported. That's my view, at least. Yeah,
well, they're completely right. And we've seen time and time again when companies have fallen over. There was that large CFD company that fell over quite a few years ago. They just had untold, unrecognised liabilities on their balance sheets. And the games the European banks play on trying to cover up the holes in their balance sheet. A point somebody made during the GFC is that one of the banks had a capital shortage of, pick a number, $10 billion. So what they did was they lent a customer $10 billion, a Middle Eastern customer $10 billion. And with that $10 billion, he immediately put $10 billion, bought $10 billion worth of shares. So with just an accounting entry, they created $10 billion of capital. but no money changed hands. So you have no idea what a lot of these banks are doing. And I think a lot of European banks have got a lot of rubbish in their balance sheets.
Yeah, and you sometimes wonder about some of the Australian banks. Interestingly, they used to report the gross derivatives exposures, but they've stopped doing that now. And in fact, the amount of transparency that we have in our local markets here with regard to the exposure of the major banks has gone through the floor. So it's very hard to know, even our, those big names, what their true exposures actually are. And that's a deliberate strategy that's been executed here locally. It's also been executed by the Bank for International Settlements, who's basically changed the way that it tells the story about what the derivatives market is and what the exposures are. So,
if we truly knew, we'd be more than scared, I think.
Well, but Michael, that's the point, because this is, to my mind, of all the other things that are going on at the moment, the ticking time bomb of derivatives and these derivative exposures, particularly in a time of volatility, right, can really be something that is going to sideswipe the financial system in a way that almost nobody will see coming. That's my perspective.
Yeah. Well, I think we've seen a few attempts at crashing the system, the GFC being the main one. The only cure the central banks have got is just to pump unlimited amounts of liquidity into the system.
Heard that before?
And we heard that before. And that's all. That's genuinely all they do. So they remove counterparty risk from the market by just flooding the market with liquidity. When in March last year, I had a few hybrids in my portfolio. And those prices of hybrids, and even though they're higher rated hybrids, but a lot of the junk bonds in America went from $100 down to $60, $55. And then the Federal Reserve makes an announcement: we will be buying junk bonds as well. They put liquidity in the market, and all the securities went back to par. So that is the only solution in the banking system at the moment, is that they expect the Federal Reserve, mainly being the world currency. They expect the Federal Reserve to put as much liquidity as is required, as they did in March last year. I had a look at the number before. They've printed 5.5 trillion in government debt and about 8 trillion in balance sheet. So it's quite a bit of cash they put into the system.
Now, and then the other point, just to be sort of completing the circle here, right? The reason that this is also important is all of these derivatives positions, be they options or futures or some of the other types of derivatives that are there, of which there are many, they actually have a direct impact on the price of the underlying. And one of the interesting observations, and gold is a good example. There are many people who are saying, well, gold should be at 5,000 US, not 1,800 US, right? Why is that? Or silver, silver should be more than $26, $28. The thing to understand there is those prices are actually not just impacted by what's happening in the spot markets, but they're also impacted directly by all of these overlays of the various derivatives that are actually out there in the futures and options markets. And in fact, very often the spot prices are actually being driven off the derivatives markets. That's something else that many people don't get.
And somebody put it in a funny way. The physical market is actually a derivative of the futures market.
Hey, I love it. That's a great way to think about it.
You can use that one because it's true. Yes. A lot of the physical markets, and you go back to your point of gold and silver. I mean, why is gold not $5,000? Why is silver not $100? It's because one of the major banks, I can't name a bank because if I'm not too sure, but they got $1 billion fine for manipulating the gold market. Yep. And last week they got another $60 million fine. And they openly admit they spoof the market. And spoofing means throwing up prices that you have no intention on dealing on. Yeah. So the market is purely manipulated. And just to mention the big dump was in end of February this year when silver went from $22, $24. It went to $30. They came in. London came in on Monday morning and just smashed it down to 24 again. And they didn't want to have a bar of $30 silver.
Exactly.
So, I see it all the time.
Yeah, and again, it's really important for people to understand. So when there is the conversation with a retail investor saying, well, you should consider options, right? You got to understand that this is the tip of this massive well of cross leverage and all of these thousands and thousands and thousands of people taking positions. The other point to make, Michael, is they also have the facility to trade very, very quickly, right? So they've got these high-speed networks and these high-speed systems, and they've got these automated trading systems. So it's not just people physically sitting at desks figuring out positions.
Well, right? We see it all day, every day at work.
And what do you think the mix of computer-driven trading versus people doing trades is? Any idea?
Look, I'd venture it'd be up. It's not 50-50, but it's up in those percentages. It's not, the base trading. Like if I even look at it in any small cap, $50 million, $100 million cap stock, I see spoofing in the morning where they just put in prices they're not going to trade. Like some share was had 100,000 they were buying, and I sold 50,000 into the 100,000 bid. Yep. And as soon as I sold 50, half a second later, because I can see it on my screen, half a second later, the remaining volume disappeared, and about 5 other sellers joined me at the selling price. Now, you can't do that unless you're a computer. So what's happened is that there's a lot of algos in the market trying to find out what the retail orders, what prices the retailers are putting their prices in at. And so the market will react to you putting a price into the market, which is mainly on shares. And a lot of the big institutions, there is one broker who's a specialist in most of his volume is a multi, probably they trade about $200 million a day. A good chunk of it is people trying to make 0.5% trades all the time. Yep. So I think it's a good chunk. Yep. Go on.
I was going to say, it's interesting, certainly some of the research that I've done suggests that as much as 80% of trades at any one point could be actually computer generated. And of course, people are also spending huge amount of money to be able to get as close to the point of trading as possible to be able to actually get ahead of other people in terms of those micro movements and those micro trades. So the whole idea of high-speed trading is another overlay on all of this, which again, it means that if you're one of the big guys with deep pockets and you can buy big computers and big networks and you can actually have line of sight to the exchanges, what it means is you get a slight advantage. Now, the other point here is the concept of market depth. And you made the point just now, which is, again, very important for people to understand, right? Yeah. Retail investors are way down the trading queue, right?
That's right.
Relative to what's called the dark pools, which are never actually reported, right? Or indeed those that are visible to the main traders but not visible to retail traders. So you're always a second-class citizen if you're a retail trader.
Yeah. And if there's one exchange in Australia, I could say two, Chi-X, that's not that big, but there's one major exchange in Australia. In America, there's I think 12 to 18 exchanges, and depending on which exchange you go to, they have different order entry rules. So you can go to an exchange. If you and I put a bid on, we'd go to the back of the queue. But in some exchanges in the US, you can pay to go to the front of the queue, which is totally unfair, as you'd appreciate. We have no idea the level of sophistication. You touched on it. They're trying to make 0.5 cent a million times a day, which is probably still not enough. They have to make tens of millions of trading decisions a day just to make a profit. Yep. And they're very happy with 0.5 cent.
Yeah, and that's, by the way, one of the reasons why nobody in the the big financial system wants financial transaction taxes brought in, right?
Oh, you remember the day back in the 80s? Because I think it was about 0.15%, wasn't it?
Exactly. So the idea is, if you put financial transactions, so every time people traded, right, they'd have to pay a little bit of tax, right? That would create a huge amount of revenue for supporting real economies, right? But of course, all of those financial people would say, at the moment we're going to lose all of our trades.
I'll 100% guarantee you the exchange would lose all its business. We would just go somewhere else. We would reinvent the wheel, let me tell you.
Yeah. I don't want to sound too alarmist, but these sorts of conversations, right, are really, really important for people to understand, right?
I think so.
Because what I find frustrating, Michael, is that if you listen to some of the people on YouTube spruiking some of this stuff, it all sounds so simple, right? Guaranteed to make money, all those things. It's just that you don't know what's really going on. And remember, this is the point I always come back to: for every trade that makes money, somebody loses money.
Correct.
Right. So the interesting question is, who's losing the money?
Well, in terms of going to the other market, contracts for difference, you may have read about the survey they did. It might have been 18 months ago. And they worked out in a 3-month period, retail clients lost $800 million because the trading etiquette of the CFDs can be puzzling. I'll just put it that way sometimes. So then ASIC have brought in, and rightly so, have really given the contract for difference guys a hard time. Yep. They removed the 100-to-1 leverage. They removed the 200-to-1 leverage. They've nowadays, if you're a retail client for CFDs, they cannot make a further margin call on you beyond your cash on deposit. And that has major. And I just want to mention that one number. They did afterwards. They did another survey recently, and the $800 million loss has gone down to a $30 million loss. So ASIC really has saved the retail clients a lot of money.
Yeah, and the same with binary options too, right? That's another what shall I say, scheme
Which options?
Binary options.
Oh, binary options. Oh, yeah. Well, they're just outlawed nowadays.
Yeah, exactly right. And again,
That's
the regulators basically saying, no, you can't do that, right?
I don't understand why in the US you can't trade contracts for difference.
Yeah.
Just don't know why. Well, I shouldn't say that. So.
Yeah.
Yeah, I'm on.
Now, there's a whole bunch of questions. I don't know whether you want to stop screen sharing for a little bit and show your face fully. We might go through some of the questions. That seems to be the way to do it. Yeah.
How do I stop this? It's okay.
Sorry
about that.
Yeah, no, that's fine. And you might want to tilt your camera because I think you may have got a bit excited and given your camera a bit of
the cleaner walked in before. And
okay.
She had the vacuum cleaner in her hand. I've gone, what are you doing? You might have seen the panic on my face.
This is real life in Pidgey. Now, there's some really great questions coming. This is one from Greg. I want to put it up on the screen again. All right.
Yeah.
If gold is a highly traded in derivatives, is it secure as a refuge of last resort in a systemic collapse?
The best place to have gold is in your back pocket, physically own it. And a lot of people will tell you that. I've got faith and confidence in a couple of the gold ETF crowds. There's Sprott Asset Management out of Canada in the US. He's very good. I mean, if you haven't got the gold or silver in your pocket, you have got counterparty risk. There is just no question about that. And it is difficult to buy a bar of gold and store it, and if you try and sell it, it's difficult. And so there's a lot to be said. But if you do buy from an exchange traded fund, make sure it's allocated gold. Make sure they are not lending it out. It is a clear fact that the reserve banks around the world lease their gold out. The gold does not leave the building. So what's happening is there's what they call a lot of lending it out and hypothecating it throughout the market. So the reserve bank. So the best place for gold or silver is collected, but look for the better custodial facility. I think your friend John Adams had a problem with one of the providers, which we won't mention, just in case they sue me. So you have to be really careful of counterparty risk.
Absolutely, and it's worth making the point. Just taking Greg Red's point a bit further, gold is a point of last resort, right? It is cruelled by all of these derivative structures that we've been talking about.
And I think when we spoke last time, we touched on Bitcoin. Is that for Bitcoin? I mean, gold can't make the leap back to a monetary standard. I mean, and that's been around for hundreds of years. For Bitcoin, nobody's going to doubt the intelligence and the very good idea that Bitcoin is, but can it make a leap to a monetary standard? That's the challenge. And I think I said last time, I think that's a fair way off. You throw in these derivatives, and the point we're clearly making here is that if you think there's only going to be 21 million Bitcoins in the market, like gold, there will be a lot more Bitcoins in the market than the 21 million because the machine is built that way.
So just to sort of reinterpret to make sure we're all on the same page, right? What we're arguing, and this is something I argue a few times with some Bitcoin, supporters. Yeah. The gold model and the Bitcoin model, in terms of the derivatives overlays, are behaving precisely in the same way, right?
Exactly my point.
And we've got a whole bunch of large financial institutions and other people all playing that game, right? So whilst there might be a theoretical limit in the underlying Bitcoin pool, right, you've got all of this other stuff over the top.
Yeah, that's right. So, I mean, I've got a chart on one of those spreadsheets I was going to bring up, but it shows the outstanding Bitcoin, the futures exchange in the US. It's not that much at the moment. It's only about 4 billion in Bitcoin. but it's early days yet. You give 12 months, and a lot of the exchange-traded funds, their asset backing is a futures contract, so again, a derivative on a derivative. So there is going to be this multiplicity of Bitcoin. It's just what the market does. And, the people who want to make money out of Bitcoin haven't got a purist idea of creating a new monetary system. They've got the idea of making a profit.
Yep.
And I'm not seeing anything that's taken away from that story.
No, and unfortunately, the whole concept of Bitcoin being completely new, different, playing a completely different game. Well, it may have started out that way, but now all of these major players are doing exactly the same game plan, exactly the same rule book, exactly the same playbook as with all of the other assets.
That's right, and you look at it. So who's all these old money players with all $1 trillion assets under management? What are they doing? They're all setting up exchange-traded funds.
Yep.
Now, the regulatory authorities in both Australia and the US do not want exchange-traded funds backed by spot Bitcoin. They've all sort of said just yes to the futures contract, which I think they feel they might be able to control. But the people with money, the people who buy votes, will expand the amount of Bitcoin available in the market. And again, think of what the concept of money. Money is only good if, whatever form money takes, is only good if you can lend it out. So, and I know there are DeFi products into the market, but can you, the Australian household market, I think, is about $2.5 trillion in debt on the last national accounts I saw.
Yep.
$2.5 trillion in debt. Well, tell me how Bitcoin is going to achieve that amount of value of money for people to be able to borrow Bitcoin to buy a house, which sounds really crazy to borrow Bitcoin. So how is that going to happen? And you either the same problem happened with gold. There's only 12 trillion of gold in the world. There's at least 300 to 500 trillion dollars of debt when you add it all up. I mean, gold can't get there. Now, Bitcoin is 10% of the value of gold at the moment, and sure, it can go to $1 million, but even that's not enough. So it's only 21 trillion.
Right. And yet, of course, there are people making, money on the way up, money on the way down, all the positioning, right?
So let's be cynical for a change. That's the game.
There are people clipping the tickets.
Right? That's what everybody does.
Exactly. And I remind everybody what I said earlier on. For every trade that wins, there's somebody who loses, right? And
Correct.
Unfortunately, the story of people who are losing stuff never get told. Right?
No.
You only ever hear the stories. Oh, I've made this, or
my story always is I won Tats Lotto. I didn't, but I won Tats Lotto, and they go, "Oh, you're lucky." I said, "No, somebody is guaranteed to win."
Yeah, that's right.
It just happened to be me. But there's 100% chance somebody's going to win the 60 million Tats Lotto on Thursday.
Yeah.
So that's 100% chance. So there's no luck in it.
Yes, just the odds are rather small.
But you know what I'm trying to say.
I do, absolutely.
Yeah.
Now, there was this other question that JB actually asked earlier on, which I'm going to throw up. It's quite a long one. Let me just put it up for you. Okay. Can you buy options in Oz and in the UK as a retail investor? I can go to the betting shop and bet on the dogs, but not trusted to hedge against market downsides.
Yeah, I saw that question earlier.
Yeah.
That was a little while ago, and it caught my eye as well.
Yeah, it's a great question.
It's a very good question, and really up until before the 5th of October, my answer would have been, no, you can definitely buy an option in Oz. I'm not too sure of the regulatory requirements of an Australian citizen being able to deal into the London market, but I'd imagine there's some facility there. I must admit the main market the Australians focus on is the American market, but new consumer legislation, which we were going to talk about later, new consumer legislation is coming in from the 5th of October, where clients now have to self-certify to trade options. They must be their preference must be for high risk. That they are knowledgeable of all the features and risks of the options. They've got experience, and if you don't certify that, the stockbroker provider will not allow you to trade. So the compliance has really tightened up. A lot more consumer regulation. We probably can go into a bit more detail of that later, if you like.
Well, let's not spend too much time going over that ground, but let's just cover it now, right? So basically, the rules have been tightened, right? And it is now more difficult. You've got to basically self-certify, but also I think the stockbrokers have their own certification processes too, don't they?
No, so as you'd expect, there are exceptions to the rule.
Yeah. Why am I not surprised?
Yeah, why are you not surprised? Why are you not surprised, Martin? I'll explain it as best I can now, which is, any product that's issued via a product disclosure statement, which includes, some credit lending, it includes medical insurance, it includes a managed fund, it includes options, because options are issued by product disclosure. So any product disclosure statement now is a generic word for it, is that the provider of that product, as of the 5th of October, must provide a target market determination of who is eligible to trade that product. And it's just not for options, it's also for managed funds. So I had a couple of screens up there I could show you later, but so all the managed funds you see, the Colonial Mutual, the Zurich, the whatever managed funds you find in Hub24 or all those platforms, they all now have to determine what sort of client is allowed to trade that product. And if you can't self-certify to who they determine should be able to trade that product, you can't trade it. So, for example, that there's a managed fund out there and it's invests in small exploration gold mining shares. So the person, the company issuing the prospectus has to say, listen, are you capable of wearing higher risk on this investment? Are you prepared to lose 50%? Oh yeah, you go yeah, maybe. Another question they could ask is, are you going to make this more than 70% of your portfolio? And if you say yes, they'll go, well, no, it can't be. We only recommend 5 to 10% of your portfolio. So there's all these risk parameters coming in for every financial product. And just to draw a bigger picture, is that in the whole spectrum of retail clients, you've got personal advice clients that are serviced by an advisor. You got the middle clients, which we call general advice clients. Product knowledge but no personal advice, and then and then we've got the sophisticated investors. Now, the personal advice clients, because you've got an advisor giving you personal advice and describing all the risks to you, you're exempt from this target market determination. But there's plenty of law inside the Corporations Act to give you protection anyway. So that retail personal advice market is very, very protected. The sophisticated market is probably the last, I'll say the last sort of outlaw. Not much information is provided. And there's an exemption on sophisticated clients as well. So you can buy a product without getting much disclosure. Where it's going to affect is this general advice client base, which somebody would say, listen, in the past, they say, listen, do you want to buy the product? And they go, and you give them the prospectus and all the information, and they go, yeah, okay. Then you find out that they're a pensioner. That's the last $10,000. So now so the old law was well, look, here's a product you want to buy, which is what a lot of banks will say to you. Here's a product you want to buy. Now the government's turned it back onto the provider and saying, listen, what's your risk parameters? Now you can lie to me if you like. But if they self-certify that they're higher risk, they've only got 10% in their portfolio, you're allowed to sell them the product. Interestingly, one product determination I saw the other day in a managed fund, it says, we will not accept your application unless you are getting personally advised by a financial planner. So they won't take anybody outside and the personal advice spectrum. Another interesting one, I saw the provider excluded robo advice. So the government is turning a lot of risk assessment back onto the provider, and in relation to what we do with options, options are issued under a product disclosure statement. And that product disclosure statement's issued by the individual stockbroker. It's sort of a quirk of the system where you'd expect that the ASX would have issued the product disclosure statement, but they're not issuing legally. The issuer is your individual stockbroker. So CompSec has its own product disclosure statement. Any one of the other Morrisons, they're issuing the product disclosure statement for options. So now they have to have this whole certification, and there's monitoring requirements. And I can tell you, from our point of view, we operate very well in a compliance environment. I also manage the compliance in our business. We don't mind it because for us, we're always educating clients and explaining things to them. We have a basis for feeling fairly comfortable in this new regime, whereas other people who just sort of email you, do you want to buy this? They're probably going to get slowed down a bit.
And just touching on the financial advisor aspect, so to what extent do you think financial advisors, one, understand these derivatives and options, and two, are giving reasonable advice about them?
Well, that would really depend on the advisor, and I can tell you now they're going to get into some dangerous territory. I mean, you might be able to get away with it for a while, but if you're writing personal advice and then saying to a client, listen, I recommend you trade some options, that personal advice file, that statement of advice, better say you're a high risk. You're going to answer all the same questions.
Yeah.
And I'd say good luck to you. I think a lot of the risk management has really tightened up over the last 10 years. I do the risk management. I understand risk. I know how to reduce risk. I mean, I can tell you now we're carrying 80% less risk than we did 10 years ago, and we're surviving quite well. So I know how to manage risk. When you get an advisor who says, do this, that, the separate corporations law will capture that bloke.
Right. Okay. Very interesting. And again, it's important to understand, help people to understand that this is again quite a complex area. Simple statements from advisors about doing X or Y. You've got to be really careful with that sort of stuff, because these days it may lead you up the garden path.
Yeah, and look, for all the best intention of some advisors, it's like I can tell you a lot of these things can really just catch you out if you're not familiar.
Yeah.
We heard secondhand a story. A guy, he had a position, and it was selling 15,000 Woodside shares. He had an option, and unbeknown to him, he got exercised, and he didn't know what exercise meant.
Right.
But he was up for 15,000 times the Woodside share price next day, and
Now, I had a couple of other questions. The one I'm going to throw at you first is this one from Greg. Can you give a quick rundown on warrants, please? Yep. City retail warrants, he was asking particularly.
We trade them very actively. So what we've done, because the options market has somewhat contracted over the past 10, 15 years, especially since the GFC, where a lot of people were caught with very bad risk management. We had the broker BBY fall over in 2015. And again, they didn't have enough capital to support the risk they were taking on their thing. I digress a little bit, but the point is that there's a lot of liquidity has got fallen out of the smaller names in the options market. Like you really want to be trying to get set on a realestate.com. Or one of the small, not the actively traded. The top 10 shares is relatively easy to get set. So then what you say to yourself, listen, how do I get the protections of the ASX and how do I get some leverage? So the product we use is the City Warrants, mini warrants, where we find that as an excellent product. So now the interesting thing is I called up City Warrants the other day and said, where's your target market determination on, because I issue a product disclosure statement as well. And they said, no, we've got an exemption because it's listed on the ASX. So, which is good. But back in the day, 10 years ago, there might have been, half a dozen warrant issuers. City Warrants is now the main one. So we find that an excellent product. It allows you to trade commodities, overseas commodities, allows you to trade foreign exchange rates. And the great thing about the warrant market is that where sometimes it's very difficult to obtain a price on an option without calling up a market maker. The warrant market's quoted in a 2 or 3 cent spread. So it's firm for volume. So to answer your question, if you want a leverage, reputable ASX provider, look, the cost of dealing warrants is that there is a 1 or 2 cent spread between buy and sell, and they do charge for. So what they do, let's take a Commonwealth Bank share at $100. Yeah, you could pay $15. When you pay $15 for a warrant, in effect, you're borrowing $85. That's what a warrant is. So inbuilt borrowing inside the warrant. So, but they do charge, I think 4.5% interest on that $85 you borrow, and that's where the money is. Is that if they've got an outstanding book of $100 million, and they're making 4.5% a year on that. It's quite good money as a funding book. Warrants are very good for liquidity, and I think for us, 10 to 20% of the business has gone there because of the lack of liquidity of the option market, and market makers have pulled out, turnovers down.
Well, certainly the warrants market has evolved and developed in Australia, hasn't it, compared with where it was a few years ago? And the good thing is that City Warrants, they were the ASX exchange, and now a good part of it's on the Chi-X because of the fees the ASX charge are obviously a bit higher than Chi-X. And when you're dealing volume, you need the lower fees. I'll just make an interesting point is that with all these, these new very cheap brokers like Superhero, Stake, Self-Wealth, do you know they actually don't trade the warrants? They actually don't trade the mini warrants. So all those discount guys, I think Stake come out at $3 a trade last week, free up until next week. And it was fantastic cheap trading, but you are trading shares. You can trade some warrants, some installment warrants, and I think you can trade some, obviously trading exchange traded funds. And it giving access to similar products in the US. All those millenniums, and since March last year, when the great influx of cash come from the Reserve Bank, from the government, hundreds of thousands of millennium accounts open. They're not trading the options because they're not available, and they're not trading the warrants because they're not available either, which I find interesting. Yeah, A lot more people thinking, interesting. That didn't quite. That's now how.
It's funny, you would think they would quote warrants. But,
Yeah.
No.
Yeah.
Look, some do quote, but if you go, I can show you the turnover figures and you go, it ain't happening.
Yeah.
They might allow it, but I don't see it.
Right. So what that says is, if you're thinking about trading with a particular exchange or a particular, set of transaction engines, it's worth understanding what they do and what they don't cover.
That's exactly right.
Yeah.
So, what the big one though, the discount model, online models left out is the option market. They've just left alone, and admittedly, it's not easy. I mean, you really have a good robust risk management systems in place. And I would have to say, even though open markets is not trading options, I think that they have got some of the better software in the market. There's no question about that. So, free hat tip to them. But they're not trading options until I think they do a cap raise or have to change the structure a little bit. But they're one of the few people who've developed some good software.
Yeah. Now, on a slightly different conversation point, Jason, thanks for the super chats, greatly appreciated. What do you guys think? How can Swift survive in the new age, whereby don't need Vostro Nostro accounts, how many $1 trillion locked up, when alternatives are emerging that actually move the money for a fraction of a cent? Swift is just... I can't read the last bit of that, so hang on. Is just the messaging. I agree, Jason. My take is they have to evolve quickly to be relevant. I'm not sure they are that relevant these days. What do you think, Michael?
Well, it's only a question of time. I mean, Swift is the problem with Swift is it's controlled by the Americans, and they can put sanctions on. I mean, they can toss anybody off the Swift system. Yeah. Is that a good idea? To try and get a transaction. I mean, I sent some euro across to Italy the other day, and it takes 3 or 4 days to get there. It's crazy stuff. Bitcoin is not the easiest to use, but it's got the Lightning thing you can put on to make it a lot quicker. I mean, once that gets moving. And we might see the central bank digital currencies as well. I mean,
don't get me started.
Don't get you started. I know it's a hot topic. But interestingly too, is the ASX has spent a lot of money on the blockchain as well.
Yeah, absolutely.
And whether they get up and running or not is another issue. But good luck. Look, and to make the point, could you imagine buying BHP shares and in the act of buying, it's also a settlement, which is the Bitcoin mantra. So that would be great. And I just have to say, in the ASX, trading ASX shares options, the requirement of settling in 2 days' time means that the broker has to have a much larger balance sheet. It chews up capital, because just to give you the legalities, that when you buy $10,000 worth of shares, BHP shares, the broker must settle that trade before they take your money. So there's no chance in hell of. I don't think there's much chance of losing money when trading shares. But the problem is for the brokers is the capital constraint. And we've just had one of the biggest, what they call clearing participants who clear trades for a lot of brokers, Pershing. They sold their business to FinClear. So Pershing was owned by Bank of New York Mellon, and they've just been trying to get out for years. It's open secret they were trying to get out, and unfortunately a good crowd. FinClear has bought it. A good bunch of technical savvy guys, and I think they got the backing from Magellan. So another strong broker coming into the market, good capital backing, and fortunately taking out Pershing to make the system a bit more stable.
Yeah, that's very interesting. I've got a load of questions. We won't get through all of them, but there's a few which we can do. This one was quite interesting from Timothy. I find it interesting that on Wall Street, the price of the S&P at day's end always seems to be where it will maximise the profit by having options contracts expire.
Yeah, well, I can tell you that's a fact of life. So,
I wonder what that is.
Nowadays we deal with weekly options. It used to be monthly options. Now we've got weekly options. So let me tell you, especially in Australia, I shouldn't say that. Trouble. If you notice a lot of volatility on the match out, so the price of the settlement is settled at 10 past 10 on Thursday morning, and how they settle the price is not the price at 10 past 10 for every share in the 200. What they do is settle on the opening price of each 200 share. So the A's to C's open at 10 o'clock and the D's to F's open at 3 minutes past, and they stagger the open. So they don't take the price at 10 past 10. They take the opening price of every stock over a 10-minute period. So you don't know until 10:15 what the match out is, and that settles the XJO future contract. That cash settles. So XJO, the index, cash settles, and then the questioning back to the comment made, you do see strange movements on the match out to settle the future contract, and big positions can really skew it 10, 20 points at times. That's not a scientific study, it's just an observational.
And it's also true of when the futures contracts themselves expire, right? And you have triple witchings and things when everything sort of hits the same point, right? And the markets can go crazy.
Yeah, so what happens is, and how options work for people to understand that the price of an option, if the underlying price moves 10 cents, the option price might move 5 cents, and we call that delta. But what happens is that as the market moves around a lot, so if a institutional investor's got $1 million exposure, which represents $2 million of underlying, if there's a sudden shift in the price against the institutional investor, his exposure, in a sense, goes from $1 million to $2 million in about 2 seconds. And that's what we call acceleration risk or gamma risk, which I'm sure, Mark, you remember from your days.
Yep.
So it's gamma risk. So what happens is that, I can buy $1 million worth of BHP options, but if BHP moves 10 cents, my option moves 2 cents. But if it runs in your favour, so what happens is the most dangerous time for that acceleration risk, gamma risk, is Wednesday night. And what happens is that you've got an option that's going to on Wednesday night. The option's going to expire worthless on the Thursday morning. But what happens is there's a 200-point move overnight, and all of a sudden it takes you out from a couple $100,000 because of that acceleration in the value of the option. So that's where the real, a lot of risk lies. And and it goes back to your comment, Martin, with the triple witching hour. So there's a serious amount of gamma risk coming into options expiries, and then what they've got to do is roll their contracts to the next quarter. And we touched on Bitcoin before. So the Bitcoin ETFs in the US, and there's one in Europe, and ours is stock related. But so the ETFs are related to, they buy futures contracts, and you actually can look at the stock of what they buy. They buy the spot month, which is November, and they'll generally buy the major quarter, the December contract. So they have two exposures of. So what happens when that expires? They must roll their contract to maintain their risk profile. They must roll the contract, and that's where the triple witching hour comes in, where there's a massive open position, and the players have to roll the contract to the next liquid month. And your December might expire, and then you go, I'll roll to January. Well, don't try and roll volume to January because it's not as liquid. You need to roll to March, and then if you roll to March, it may be a short squeeze, and you see strange things happen, and not the least, which you saw in the oil contract in March last year when it went negative $30, and the poor chap on Robin Hood bought an oil contract for $1, thinking that's all he could lose, but he lost 38 or $6 million.
Yeah.
It was.
And it's that multiplication factor, right? Positive and negative.
That's right.
Which is the thing that, again, I have to keep underscoring. When you get into these leverage types of situations, it can go against you very, very, very quickly, right?
Yeah, that's right.
And the amount you're up for, right? It can be a huge multiple of what you thought, right? And I've seen so many people get caught.
So I think I read one of your comments early in the piece that this reminds me of my Year 12 mathematics.
Yeah.
And in our business, you can get by with Year 12 mathematics because you can. And the comment about the Black-Scholes formula, Black-Scholes formula is not much more complicated than Year 12 maths. But what you got to remember is the old bell curve, with which you did in derivatives and statistical analysis, and you can see as you move from right to left, there's much more area under the curve.
Yeah, absolutely.
It's an accelerating process.
Yeah. Well,
dx dy.
When I used to teach options, I used to demonstrate the difference between the put and the call, right? Because, of course, the characteristics and the profiles are very different, right? In one scenario, yeah, you might lose your premium, but that's pretty much it. But in the other scenario, right, if the market moves against you, it goes on and on and
forever.
on.
And let me tell you, that's what happened in 2008, 2009, is that the favourite retail punter, unsophisticated, was to sell puts. So just to briefly explain to people who are not as familiar, so if you've got Commonwealth Bank shares at $100, you can say, listen, I'll sell an $80 put. Now what that means is that if the Commonwealth Bank share price goes under $80, you own it. The guy has got an option to give it to you at $80. So, but the chances of Commonwealth Bank going to $80 by next month is fairly minimum to non-existent. And the only problem is, it's only a problem when it does happen. So what a lot of people are doing, they were selling these puts till the cows come home, making $10,000, $20,000, $30,000, $40,000, $50,000 a month because they never went wrong.
Yeah, and just to be clear, they get a premium, right? Every time they sell a put, they get a few dollars, right? So,
yeah, thank you for saying that.
Yeah. So that means if it's never exercised, it's money for old rope. They keep the premium.
And if it expires worthless and you keep that $10,000 premium, you just roll it to the next contract. And they were doing it. And how the other way they got caught, which is normally half the time you can post for margin, you can post cash. The other thing you can do is post shares. So the problem is there's some bloke who's got $250,000 worth of shares and he posts that as collateral. He doesn't see the margin coming out of his account. So he's up in the with Sundays, blissfully having a Sunday. And nobody's asking him for money and the market's falling out of bed. And before you know it, you've heard stories of people who've lost $2 million. There was a court case of a high-profile chap who lost $9 million on that strategy, and then he put his house up as security, and then he went to the high. I think we went to one of the higher courts to try and defend that action. But the point was that because the brokers didn't have the risk management in place, they were just a lot of brokers were taking it to the cleaners on and incurred a big loss because their clients couldn't meet the margin call.
Absolutely. Well, the margin call situation, particularly with the derivatives, is something which, again, people don't fully understand. And I frankly don't think often it's very well explained. But the point to make is, if things go in one direction, you'll do fine. But if things go in the other direction, you won't. And then people start knocking on your door saying, hang on a moment, you've got to make it up.
Let me say to you that naked, what we call naked selling, is probably a thing of the past.
Yeah.
Because the brokers just do not have enough capital to support that business. So what you can do, for example, and this is what we do for all our clients, is that if you sell, let's say, take that example again, you sell $80. Now, you know your risk is, if you've got 10 contracts and 10 contracts times 100 shares per contract, it's 1,000 shares. So 1,000 shares, $80, that's an $80,000 risk you've got. So what you can do, if you sell the $80 put, what you can do is buy the $70 put. So what you do is you just reduce your risk to $10. So if it goes under $70, you can exercise that back against somebody else's.
Yeah.
So you obviously know the point.
Yeah, and the point there, of course, is that the premium that you have to pay at 70 is lower than what you'd be receiving at 80, right? Because the probability of going there is lower.
Yeah. So the example I was running before was that, for example, you might have got 10,000 premium at 80, just selling outright. But if you take the protection, you'll get a $5,000 premium.
Yeah.
But your risk goes down by about 70%.
Absolutely.
So the risk-adjusted return is much better if you're taking protection. And I'll express it another way, in that let's say, well, the common bank share price is about $97. I didn't see the close. Let's say $97. And let's say I think the Combank market might go to $85. But when you but you don't believe it's going to go much further than that. So it's a very realistic strategy just to buy the protection at $80, because it's probably not going to go only one chance in 100. It does.
Absolutely, but it shows you the need to get a bit more sophisticated, and you get into what I call financial engineering, right? Where basically you build these risk-adjusted structures, but of course it gets more and more complicated to be able to actually work out precisely the way it works. And I remember spending many a happy workshop with banking executives trying to get their heads around this stuff, right, so they could see how you could protect it or not protect it, and what they're. I mean, it can get quite complicated quite quick.
I can tell you now, managing the portfolios for all our clients, or understanding the risk. I know where the risk comes from, and it we touched on it before. Wednesday night, there's only if you had a month to run and the market fell 100 points, you might lose 10. But if you only got a day to run and it falls 100 points, you lose 100 points.
Absolutely right, and that's the duration question and all those things. Now we're running close to the end of the show, but there's a couple of other questions I wanted to touch on. Wiser 3754 said Russia now has more gold reserves than US dollars. Are they preparing, or could they create a fiat currency black swan event? Certainly Russia is not without the conceivability of creating havoc, in my view.
I think that point goes back to the SWIFT question before, which is, I think Russia has sanctions on it in using the SWIFT system.
Yeah.
And it's probably the reason back in the 60s that what we call the offshore US dollar market, the unregulated market, started, because Russia needed to deposit its US dollars with a bank. If it deposited the US dollars with a US bank on an American regulation, they would have had sanctions on it, which is, it's just, that's not a theory, that just happens, doesn't it? So, let's be honest. I actually look at who owns the gold in the world, and the World Gold Council does a magnificent spreadsheet on which central bank every month buys and sells gold.
Yep.
And let me just it's a very clear picture in that the eastern countries, China, Russia, probably Turkey, so the eastern countries are buying gold, and the western countries are generally selling gold. And because, just because, I suppose. No, I think that the general thing is that the people are asking themselves, well, listen, when's the US dollar as a reserve currency, when will that end? Well, they're fairly well entrenched, and it's a long way away from that. But there's been plenty of story about secret gold buying by China. If you look at who owns the gold and it says Belgium, that's China. And especially who owns US Treasury. In the tick data, it's Belgium, it's China. So I think the eastern countries are definitely building up a block of gold, and you can just see it over time. And Australia really hasn't moved its gold. I think.
Well, ours is still in London. Ours gold is still in London in the Bank of England, right?
Because they're not going to give it back to you.
Well,
I think Germany wanted their gold back in 2013.
They did. No, it didn't work.
And they were politely told no.
and even trying to get it audited is a bit of a problem. Now, here's one just to sort of end the show on. That's just from Cookie Boy. Hi, Cookie. Does Michael see a flash crash, major crash in the markets anytime soon, and what could trigger it?
So it's all about liquidity. So Steve Keen, the economist, was very keen on always talking about the credit impulse, and Steve's point is that the neoclassical economists who run the world's economic theory and reserve banks don't believe money is involved in making economic decisions. So I'm a person who believes in cash flow and credit creation, or the credit impulse. So I'll just make a couple of points on the credit impulse. Is that there's only two entities that can make money in Australia, which is the federal government. Can make money, but just by spending it. And the other people who can make money are the banks, because when they lend, when they make a loan for $1 million, they create $1 million in cash. And so the question is, what will trigger a market is if credit creation really slows down. If the people who manage our government's bond issues are the Australian Office of Financial Management. You can go to their website, and they actually tell you in a nice, clear Excel spreadsheet that whereas if you went back 6 months, they issued 200 billion securities. Over the past 12 months, as you know, they put 200 billion in the system. But if you look at the last month, which is 31st of October, the government's actually gone into surplus. So the government is not only not spending on paper, they've actually up about $20 billion in the last 3 months. So the money creation by the government has at this stage slowed down, and that's absolute policy from the government. I think they were loath to go into the deficit, and I think they did the right thing. I went in 200 billion, but I don't think they want to maintain that. And I think the politics of the government is to go back to surplus, and that means there's going to be a lack of a credit impulse from the government. There was a bit of talk I was going to do about private debt, and I just want to make a point about the private debt, because I won't waste all my slides, is that the Australian Bureau of Statistics put out much more broader credit numbers for the economy, and our credit, excluding banks, in the economy is $8 trillion, and our gross domestic product is $2 trillion. So at the moment, our total debt is 4 times, 400%. And people will say, well, that's terrible, we're going to crash. Well, it hasn't crashed for 20 years, so it's probably not going to crash tomorrow on that basis. But what turns an economy down is when so I mentioned the government creating money, is when the banking system slows down on creating money. And if you went back to March 20 last year, the credit impulse from the bank lending was basically down to zero. And crazily, I'll say, the best thing that happened in the economy was COVID, in that it gave the central banks an excuse to make money, and which did so well. And I'll tell you now, there was a negative credit impulse coming back in March last year. So this time around, what can happen, I think, if there's a fear of interest rates rising, that'll affect the credit creation by the banks. the government's already into no credit creation. I think we're picking it up. I think, Martin, when you talk to Edwin on Monday night, I think you're touching on those type of issues. There's a bit of pullback on the consumer sentiment.
Yep.
And, people who, there's a couple on the ABC saying they stretched their money to buy a $1.75 million house. Good luck to you. so I'm sorry that was a long answer, but I think this economy absolutely relies on money creation, money being poured into by the governments. If the governments use their old theories and say enough is enough, I think we'll be in trouble. But as usual, when trouble appears, the Federal Reserve, as in like 2013, changed their mind pretty quickly. So I think, 10-20% fall, they'll have to step back in because it's all over if they don't.
So, I mean, I think the credit creation story, and Steve Keen, by the way, Steve Keen is coming back on in a few weeks on the show again because we've had so many questions that we couldn't get to last time. But the whole point there is, governments might be trying to dial back, but private sector deck, of course, has been quite strong. Easing back now, the credit momentum will probably be the critical indicator, the forward indicator. And I still think that a crash is still likely at some point. So we'll see.
I know, and you can see, I'll agree. It's subject to what their reaction is that I think they've gone to the surplus mentality against the feeling I get. I mean, there's been good times for everybody with the stamp duty increases and the revenue increases and the shops have again. So they're probably feeling the effects of that and feeling really confident they can get into a surplus.
Absolutely. Okay, last question quickly. We're nearly out of time. In fact, we're pretty much time. I'm a fan of options, but a question I always get when telling people to be proficient options is it worth trading Australian options compared to US options due to low liquidity and fill in Australia? Great question to finish with.
Great question, and an honest answer is that if you go to the US market, you will get unlimited liquidity in any strike, any month. What we do in our markets, because we do spreads, we do 2-leg spreads, we do 4-leg spreads, and we call that a combination. We combo it up, and we trade it as one trade. Now, I might get 1 or 2 market makers interested in a combination trade, and I'll probably have to call them up to get a price. But you'll get a reasonable price. So it's the liquidity is not there. If you go and create that combination on the US market, you'll have 20 people lined up either side to make your 1 cent spread. And I just have to say that. But what's interesting is that that there's not much access to the US option market in Australia except through a couple of platforms. So it's not that common, but and then the US markets, well, it's just got so many more products as well. I mean, you could buy, I like the uranium product they issued out of Canada and the US. I mean, you go buy an option on a uranium product. Buying a pure option on a silver contract is impossible in Australia. So you get a lot more diversity of commodity.
It's a bigger market, it's a deeper market, it's got more liquidity, it's got more capability, more accessibility, et cetera, et cetera. It's just that if you're in Australia and you're doing stuff in the US, you've always got the exchange rate risk.
Yeah, that's right. But if you're dealing in the small, if you're using 5,000 to trade, it's in terms of maybe your net worth and right up with that. But I do have to say, as a plug, that we are coming out with a platform to be able to trade US equities and options. So, and we see that we see a market that because of the capital constraints in Australia, turnover is going down. You can only trade the 10 bigger names. So, and as the discussion has shown, where the less liquid names, we've moved to the mini warrants, gives pricing certainty, liquidity. And I think as technology evolves, and there's quite a few good tech players on the stockbroking side in Australia, we'll see the US option trading, I think, coming through next few years.
Well, Michael, I really thank you for your time. We're way past our close time, so we should probably...
Really? 5 minutes?
Yeah. Can you believe it? We didn't get through many of your slides, but we actually covered the critical points that we both wanted to cover, right?
No, that was good. I think we covered all our points.
Yeah, exactly right. Well, I just checked them off, and we have, and thank you all for the questions. I got most of them covered, not all of them, but most of them. And I just want to say thank you to everybody for the Super Chat contributions and for the questions and for sticking with us. So I will say thank you very much to you. Now, if people want to know more about what you're up to, where do they go?
You go to traderscircle.com.au or emeraldequities.com.au.
Great. We'll put the links in the comments below as
put
well.
the links up there, but always happy to talk to a friendly person.
Yeah, wonderful. Well, thank you for your time. Thank you very much for sharing your expertise. And we'll have to do this again sometime because there's so much more that we could explore, right?
Yeah, it's endless. There's a lot of interesting things I could talk about.
Absolutely. Well, I think you've certainly piqued everybody's interest tonight, and I think some of your messages have been really important.
Really appreciate the invitation, and as you know, I'm a keen follower, so...
Well, I appreciate it. Right, well, I'm going to take you offline now. Thank you very much. Have a good evening, and then I'll close the show. So see you later.
And good night. Good night to everybody.
Thank you, Michael. Right, there we are. So that was a really interesting chat, and so many important messages there for people considering options. Be careful, be cautious, right? Do the homework is what I would say to that, but there you go. So thank you very much. Just in terms of next week, just to let you know that I'll have Damien Klassen on next week, and we'll be looking at the markets. Very important time now, bearing in mind what's happened. We know we've got the confirmation that Powell is going to maintain his footprint at the Fed for another 4 years or thereabouts, and all sorts of exciting things like that. So consequences, inflation, probably more substantive than we thought. All of those questions we'll be addressing next week. So I want to say thank you very much for spending time with us this evening. Hope you found it useful, and keep watching the shows, and come back next week for another show on Tuesday evening. This is Martin North from Digital Finance Analytics signing off. We'll see you next time. Goodbye.